it's Jared Hope with Tilt Property Group, just doing a follow-up video to a post I did, I put on the internet, on Facebook there the other day, with stocks versus real estate. This is take 2, version 2 of it. And we've been getting some, I don't want to say backlash, but just some comments, just random comments from people that either don't understand real estate or question my numbers or just are just pro stock. So I'm going to break it down a little bit further. So stocks versus real estate, pretty simple. The example I gave the other day was a $60,000 investment. $60,000. Okay, so a $60,000 investment in real estate gets you a $300,000 asset. So the camera's going to zoom in and out on the picture so you can see the numbers very, very clearly. So a $60,000 investment in real estate gets you $300,000. A $60,000 in stock investment gets you $60,000 of stocks. So a stock will go up 5 to 7% year over year on average. So if you look at the last 25 years, stocks will typically go up 5 to 7%. Real estate will go up 3 to 5% on average. Interesting enough, in Edmonton, Alberta, real estate's gone up in the last 25 years, 5.87% on average in the last 25 years. So let's use these numbers. Let's use 7% and 5%. So the two highs of both divisions, okay? So in a stock, if you were to buy $60,000, get 7% return, you're going to get $4,200 per year. So once again, I'm just trying to get real numbers, more accurate numbers. I used 10% in the last video, and the reason why I use 10% is just it allows me to do quick math, just for demonstration purposes. But unfortunately, not everyone understands just this simple example. So we're going to break it down even further. So you're going to get $4,200 per year off of a $60,000 stock investment at 7%. Pretty good, nothing wrong with that. And once again, I'm not saying real estate's better than stock. I'm not saying stocks are better than real estate. I'm just breaking down an example of different ways to leverage your money. So on the $60,000 in real estate, $300,000 investment at 5% return on your money, that's now $15,000 a year of appreciation. Okay, so that's appreciation, that's pure value. Now, for those of you who are sitting there saying, well, I can reinvest that money back into the stock and that 7% actually grows more and more. Listen, we're just using really simple math right now. Same thing can be said with real estate. This $300,000 goes to $315,000, it goes to $332,000, so on and so on. So let's just really break it down really simple and just use year over year numbers without rolling the profit back in. So 5% on $300,000 is $15,000. Plus what you're going to get is something called mortgage buy down. We've talked about this before. In every mortgage payment, you get an interest payment and a principal reduction payment. So on this mortgage buy down, sorry, wrong arrow, on this mortgage buy down, you're going to get about $6,000 per year of mortgage buy down. Now, that's being paid down by the tenant, not by you, because you're collecting rent, and therefore you're taking that rent money and using it to buy down or pay your mortgage payment. You're also going to get something called cash flow. Sorry for the sniffles, I'm just getting over a cold, so my voice might be a little off too, but I thought it was very important to get this out because there's a lot of comments being made about the video. Cash flow, I use numbers. I always like to get a $500 a month cash flow, but for this example, I used $500 a month in the last video. So let's really make it conservative. Let's say we get $300 a month of cash flow. Okay, $300, that's after your mortgage, taxes, insurance, property management, vacancy, and repairs or maintenance are all covered. Now you get an additional $300 in your pocket. So that works out to be $3,600 per year of cash flow. So with all that said, that's going to be $24,600 per year of money in your pocket. Now, this isn't real money because you can't crystallize it because it's stuck in the house. This is, once again, not real money because you can't crystallize it because it's stuck in the house. But this is absolutely real money. None of this is real money either until you crystallize it. What I mean by crystallize it is actually selling the product. So one of the comments made on one of the posts is, well, real estate, there's all these additional costs that people just aren't being told about. So it's all bullshit. That's what they're saying. Well, that's bullshit. That's a stupid statement. Because here's the thing. I own hundreds of properties. I've transacted close to 300 properties in the last 14, 15 years. And on average, every 2 to 5 years, so let's say every 4 years, we're spending $5,000 a month, a year every 2 to 4 years. So at the 4-year mark, let's say we spend $5,000 at the 4-year mark to put back into our property. That works out to be $1,250 on average per year that we're additionally spending into the property. So let's just play devil's advocate just for a second. So let's say it's $2,000 additionally that we're spending on our property above and beyond anything else. So that's money actually coming out of our pocket. So that means we're netting out $22,600 a year off of the same $60,000 investment. This works out to be, if you're to take 25 years, this is going to work out to be, if you times this over 25 years, this is going to work out to be $105,000. Not bad off of a $60,000 investment. That's 175% ROI. Pretty darn good. With real estate, this is going to work out to be about $565,000 return on your investment. That's not bad either. A little bit more risk for sure. However, if you buy properly, if you buy the property properly, that's a tongue twister, you're actually going to set yourself up for success. Now, I'm not saying do one or the other. They each have their equal concerns and risks. All I'm saying is just don't shut one out for the other. There's lots of people who are out there hammering me right now because they're pro stock. Well, I'm pro real estate. I'm not out bashing stocks. I'm saying do both. Now, let's break this down even simpler. Real estate versus stock. For all those people who love stocks so much, let's break this down even simpler. So let's say the market goes up 5%. So that's $15,000 a year. Let's say you get cash flow of $0. So all of your money is going back into your property because the thing keeps on flooding, you keep on getting vacancy, rents drop, by which your cash flow is based off of your lowest rents in the last 7 years. So the $300 of cash flow today, you should be able to attain that and maintain that for the next 5, 10, 15, 20, 25 years if you buy properly. Where people make the mistakes is they buy the shittiest property in the best area and they think they're going to get the best results. That system doesn't work. Whoever's teaching that has to stop. So let's say you get zero cash flow, but you still get your mortgage buy down. You're always going to get your mortgage buy down, which is $6,000 per year. So now you're at $21,000 minus say you're spending $4,000 on average a year. Sorry for the sloppy math. Let's say you're spending $4,000 on average a year. You're still $17,000 in the positive with real estate. Now, once again, I want to be super clear. I'm not saying real estate's the best thing in the world. There are lots of challenges that come with it. We've been self-managing. You got to deal with tenants. You got to deal with emotions. You got to deal with all kinds of drama that tenants bring to the table. But same thing with stocks. I've also bought stocks that one day they're worth this and the next day I've lost all my money. Now, we don't own many stocks. I am not against stocks. I just prefer and decided to jump into real estate. I'm pro real estate. If you're not pro real estate, just delete the video. Don't even watch it. Don't even post a comment about it because I'm not looking for a fight. All I'm trying to do is just show the example and the power of leveraging your money for a bigger asset value, which is going to get to the same return across the market. Let's do one other example. So let's say real estate goes up. So let's say stocks go up 5%, but real estate goes up 3%. Okay, so now let's say stocks are outperforming real estate as far as the return value. Well, that's still $9,000. You're still going to get your $6,000 no matter what of mortgage buy down. You're still going to get your let's say you're not getting any cash flow. So let's say you get zero cash flow. That's still $15,000 per year. So now let's say you're still spending that $5,000 per year average on renos or repairs. So now that's $10,000 per year times 25 years is $250,000 return off of the same $60,000 investment. Does the math work? It does for me. Does it work for you to do stocks? It doesn't for me. That's all I'm saying. Some people, this works. It's easier. You can get in, you can get out super quick. That's a comment that was made. That's not necessarily true either. Because in the first 5 years, I would agree that stocks are easier to get in and out of. Get out of. In real estate, after 5 years, once you've rounded the corner of your first 5-year term, it's now pretty liquid. The asset's pretty liquid. Because now all you have to do, you can just reduce your price and move the product quickly. worst case scenario. So once again, my name is Jared Hope. I just wanted to do a stock versus real estate version 2. Share it, like it, comment. If you're a pro stock guy, don't start bashing me. That doesn't make any sense. I'm not bashing you. These are just some quick examples of how power of leverage works in both industries. Once again, Jared Hope, Tilt Property Group. Share it, like it, follow us on Facebook, and happy investing, everybody.